If you've ever stared at your brokerage screen thinking I have no idea what I'm doing, you are absolutely not alone. Most people feel exactly like that and quietly give up. The result is always the same: years passing, prices rising, paycheck feeling tight, and that strange feeling of working hard but never building a real income machine for the future. Today I want to change that for you. I want to show you how to turn a single decision and a single portfolio into something I call your dividend income machine. This isn't about guessing meme stocks, trading every day, or pretending we're hedge fund managers. It's about building a simple, boring, extremely powerful system for long-term dividend income. And I'm not just talking theory. At the end of this video, I'll show you how Emma's one-time $25,000 investment could grow past $2.5 million over decades. Along the way, that same dividend income machine could pay her tens of thousands per year in dividends, without her needing to constantly watch the market or chase hot tips. So if you care about freedom, not just a nice number on a net worth tracker, stay with me until the end, because the structure I'm about to share is the entire game. Before we dive in, take a second to hit like, subscribe to Dave's Dividend Lab, and tell me in the comments how much dividend income per month would feel life-changing for you. Let's start with the uncomfortable truth. Most people do one of two things with their money. Either they leave it sitting in cash, or they shove everything into something that feels safe and forget diversification. Cash feels safe because the balance doesn't move. But over the years, inflation quietly eats it. The same groceries, the same rent, the same lifestyle start costing far more than before. Others go all in on fixed income, thinking that a stable interest payment is all they really need. It looks calm on the surface, but long-term inflation and taxes slowly squeeze that income. Imagine someone living off $50,000 per year from bonds. After enough years of 3% inflation and a big tax bite, that purchasing power might look closer to $25,000 in today's terms. On the other extreme, some investors discover stocks and decide to avoid boring diversification entirely. They put most of their money into 2 or 3 companies they adore, and while everything is going up, that feels brilliant. Until one earnings report, one scandal, one regulatory change hits, and suddenly a huge chunk of their future evaporates overnight. We've seen massive companies that looked untouchable until they weren't. Workers, pension funds, small investors, everyone believing nothing could go wrong until everything went wrong. Between these two extremes, a lot of people just freeze. Too scared of losing money with stocks, too worried about inflation with cash, and too overwhelmed by information to build a plan. That's exactly why I built the concept of the dividend income machine. It's not a magic portfolio. It's a process that makes big mistakes much harder to commit. Instead of asking, what's the next hot stock, you start asking 3 better questions. How many stocks? How much in each? And how spread across sectors should my money be? When you answer those 3 questions with clear rules, you remove 90% of the noise. You stop jumping from video to video and finally start assembling something that can actually pay you. So let's define it clearly. Your dividend income machine is a portfolio of dividend-paying companies, built with simple rules designed to grow both your wealth and your income for decades. It has one mission: turn your capital into a reliable, growing cash flow engine that keeps depositing money into your account while you're busy living the rest of your life. And like any machine, it has parts. If you throw random pieces together, it breaks. If you design the structure first, it becomes strong, predictable, and surprisingly easy to maintain. The structure of the dividend income machine is built on 3 pillars: the number of stocks you hold, the size of each position, and the maximum weight of each sector. If you ignore any of these pillars, you might still get lucky for a while, but eventually one weak point gets exposed, usually at the worst possible moment in the market. Our goal isn't perfection. Our goal is resilience. We want a portfolio that can take punches, survive bad headlines, and still keep sending cash your way year after year. Think of it like building a bridge. You don't need to predict every storm. You just build the structure strong enough so that storms become part of the expected journey, not the end. And remember, everything I'm about to show you will apply at the end to Emma's real numbers. You'll see exactly how the machine looks with actual capital behind it. Let's start with Pillar 1. How many dividend stocks should you actually own to make this thing both powerful and manageable? Ask 10 investors that question, and you'll get 10 different answers. Some swear by ultra-concentrated portfolios. Others own so many positions they can't even name them. Here's the problem with owning just a handful of stocks. Your entire future rides on a tiny number of decisions. One big mistake, and your long-term plan takes a huge hit. Imagine your portfolio has 5 stocks, and one of them drops 80% permanently. That's not just a bad day. That's a deep scar across your long-term compounding. On the other hand, if you own 80 or 90 individual stocks, you might feel diversified. But realistically, you'll struggle to follow earnings, news, and fundamentals for all of them. You don't want to be the investor who owns everything and understands nothing. That's how people end up holding landmines they never bother to investigate until it's too late. So instead of chasing an extreme, we aim for a sweet spot where you get most of the diversification benefits without drowning in complexity or homework. Studies over the past decades show something very clear. As you add more different stocks, the company-specific risk falls very quickly with the first additions. After a certain point, though, each new stock reduces risk only marginally, while adding more and more monitoring work. The returns of that extra effort start to shrink. For most individual investors who want dividend income, a reasonable range is somewhere between 10 and 25 stocks, depending on their time and comfort level. Below that, one bad pick can hurt a lot. Above that, you start turning your portfolio into a personal index fund without the convenience of a simple ETF. For our dividend income machine, I like targeting something around 15 to 20 positions, enough names to spread risk, but not so many that you lose track. Think about it. Following 15 companies deeply is challenging but realistic. Following 60 deeply on top of your job, family, and life is almost impossible. So, Pillar 1 of the dividend income machine is simple. Aim for a focused basket of roughly 15 to 20 dividend-paying stocks, not 5 and not 50. With that range, you're not betting your future on 1 or 2 heroes. You're building a team where several players can have bad seasons without destroying your chances. That brings us to Pillar 2. How much money should you allocate to each position inside this basket of dividend stocks? A lot of investors choose favorites. They put extra money into whatever feels safest or most exciting, and tiny amounts into the rest just to diversify a bit. The problem is obvious when you zoom out. Their portfolio ends up being dominated by 3 or 4 names without them noticing, turning those into hidden single-stock bets. Even professionals with massive resources often fail badly when trying to choose who will be the big winner of the next decades. For regular investors, that's even harder. So instead of trying to outsmart the future, we can choose a more humble but more powerful approach. Start with roughly equal-sized positions across your holdings. Equal weight simply means this. If you're investing the same capital into each stock, no single company becomes the giant that can sink everything if it fails. Let's say you have $10,000 and decide to build a portfolio of 15 dividend stocks. You'd aim for around $600 to $700 in each one, approximately. If you have $25,000 and 17 positions, you're looking at roughly $1,400 to $1,500 per company as a starting point. The exact number doesn't need to be perfect. The principle matters more than the precision. Every brick of your wall starts with similar size, so no single brick becomes critical. That way, if one company cuts its dividend or suffers a permanent decline, it might hurt, but it doesn't wreck decades of planning in a single move. Equal weighting also protects you from your own overconfidence. The stocks you love the most no longer automatically become half your portfolio, only because emotionally they feel safer. Over time, some positions will grow faster than others. That's normal. You can then decide whether to rebalance occasionally or let your winners become slightly larger naturally. The key is this. You don't start by making giant bets. You start by spreading your initial capital with discipline, letting the market show you which businesses truly deserve more space. So, Pillar 2, roughly equal position sizes at the beginning, instead of huge emotional bets on a couple of names you think can't possibly disappoint. Before we go to sectors, quick breathing pause. If this is making the game clearer for you, let me know in the comments with the word clarity, so I know to keep bringing this kind of content. And if you haven't yet, hit like and subscribe. It really helps the channel grow and brings more long-term investors like you into this community. Also, save this video in a playlist called Dividend Plan, or something similar, so you can revisit these pillars whenever emotion tries to pull you off track. Now we can dive into Pillar 3, which many people ignore until they feel the pain firsthand: sector exposure. You can own 20 stocks and still be dangerously exposed if 15 of them live in the same sector or move with the same economic forces. Imagine a portfolio where everything is tied to interest rates, or everything is dependent on commodity prices, or everything depends on one specific part of the economy staying hot. When that specific area gets punched in the face, your diversified portfolio suddenly behaves like one big concentrated bet. The drawdowns become much more painful. Different sectors react differently to inflation, interest rates, technological change, regulation, and consumer behavior. That's exactly why sector diversification matters so much. In the Dividend Income Machine, we impose a simple rule: no more than 25% of the portfolio in any single sector. That means if you have 16 or 17 positions, you're not loading half of them into one shiny theme only because it's trendy this year. Maybe you love banks, maybe you love energy, maybe you're obsessed with technology. The rule is there to protect you from overdoing any of those personal preferences. At the same time, diversification by sector doesn't mean forcing yourself into business models you simply don't understand or feel uncomfortable owning. You don't need to buy a complex biotech company you can't explain just to tick a healthcare box. That kind of diversification is pure illusion of safety. A good rule of thumb is this: if you can't explain the company's business to a teenager in simple words, it probably doesn't belong in your personal dividend income machine. That keeps your portfolio inside your circle of competence, while still forcing you to look beyond one or two familiar sectors when building it. A healthy structure might include a mix of energy, utilities, financials, healthcare, consumer, industrials, technology, and maybe some real asset exposure like certain REITs. You don't need all of them, but you also don't want a portfolio where 14 of your 17 positions depend on the same 3 macroeconomic variables. When one sector struggles, another might be quietly thriving. Sector diversification lets the strength of one area soften the weakness of another, while dividends keep being paid. Pillar 3 is therefore very straightforward: a limit of 25% per sector, as long as you truly understand what each business does. With these 3 pillars in place, we can finally build a real example of a dividend income machine and see what it might do for someone like Emma. Let me introduce Emma. She's not a professional investor. She has a regular job, a family, and very limited time to research markets deeply. After years of saving and small investing attempts, she finally accumulates $25,000 that she wants to dedicate to a long-term dividend strategy. She doesn't want to day trade. She doesn't want to check prices daily. She wants a system that can quietly build wealth and income in the background. Together, we decide to build a dividend income machine for Emma with 17 stocks, all dividend payers, spread across several important sectors. Some of those companies operate in energy and utilities, providing essential services people use regardless of economic cycles, often supporting stable dividend streams. Others come from financials and insurance, businesses that manage risk, credit, and capital flows, often rewarding shareholders with consistent and growing payouts over time. We also include healthcare companies with solid track records, because people don't stop needing medical care just because economic conditions are difficult. Add to that a handful of large, profitable technology and industrial companies that have matured enough to share profits through dividends while still growing earnings. Each of these 17 positions receives roughly the same starting allocation from Emma's $25,000, following our equal weight principle from Pillar 2. That means Emma isn't secretly turning any single stock into a gigantic bet. Every piece of her machine starts with similar importance inside the structure. Combined, these companies offer a blended starting dividend yield, a history of dividend growth, and a track record of share price appreciation across many years. We're not assuming perfect futures. We're asking a simple question: if the averages of these metrics persist reasonably, What kind of picture might Emma's future look like? Let's walk through a hypothetical scenario. Emma invests $25,000 once, reinvests all dividends, and lets the dividend income machine run for 30 years. In the first 10 years, the combination of price appreciation and reinvested dividends could grow that portfolio to something above $100,000 without any additional contributions. After 20 years, the compounding effect becomes much more visible. Her portfolio might cross the $500,000 range, with dividend income already making a real difference annually. By around 30 years, under reasonable assumptions, that initial $25,000 could cross $2.5 million in value, with dividends alone paying tens of thousands every year. At that point, the story isn't just about a big number on her account. It's about choice, working because she wants to, not because the next paycheck is a survival question. That is what a well-designed dividend income machine really offers. Not magic, not guarantees, but a serious chance of buying back your time through discipline and structure. If this resonated with you, hit like, subscribe, and tell me in the comments what your target annual dividend income would be. And when you're ready, watch the next video on screen to learn how to start even with tiny amounts.